Picture this: a quiet financial force that has been powering global markets for more than 3 decades suddenly starts to shake. And nobody's ready for what comes next. Most people have heard of interest rates, inflation, or stock bubbles, but almost no one knows about the mechanism sitting at the center of it all, quietly holding everything together. It's called the Japanese carry trade, and right now it's showing signs of stress that could send shockwaves through markets worldwide. If you've ever wondered how a country on the other side of the world can influence your retirement savings, your investments, or even the value of your home, this is a story you'll want to hear. And before we go deeper, if you're finding this kind of breakdown valuable so far, please take a moment to like this video and share it. It really helps more people understand what's happening behind the scenes. So, what exactly is this mysterious carry trade, and why do economists sometimes call it the hidden engine of global finance? Well, at its heart, it's actually a simple idea. For more than 35 years, Japan kept interest rates near zero. That meant anyone, hedge funds, big institutions, wealthy investors, could borrow Japanese yen at almost no cost. Then they'd take that borrowed yen, convert it into another currency, and invest it in places that paid higher returns: US stocks, European bonds, real estate, commodities, even crypto. The difference between the low borrowing cost and the higher investment return became pure profit. And because money was so cheap, investors didn't just borrow, they borrowed big. They used leverage, piling borrowed money on top of borrowed money to multiply their gains. When borrowing costs next to nothing, it feels like free fuel for every financial engine. So over the years, Japanese money helped lift the US stock market, funded massive real estate developments, supported private equity buyouts, and even played a role in crypto booms. It's quietly everywhere, like oxygen in the financial atmosphere. Here's where things get even more interesting. Some of this yen-funded activity gets buried in complicated financial instruments: derivatives, structured notes, volatility strategies. Some analysts estimate the size of the carry trade at $2 trillion. Others put it closer to $20 trillion or more. No one knows the real number. What we do know is this: it's enormous, and it touches almost every corner of global finance. And when something that big starts to shake, the ripple effects don't stay quiet. The danger comes when the trade suddenly becomes unprofitable and begins to unwind. And right now, several warning lights are flashing. Japanese bond yields, especially long-term ones like the 30-year, have jumped to levels not seen in decades. And when bond yields rise, their prices fall. This is the seesaw effect most people forget. Higher yields mean lower bond values. Japan, with the highest debt-to-GDP ratio of any major country, relies heavily on keeping yields low. When yields rise, the value of its own bonds drops, putting pressure on banks, pension funds, and even the government. This is the type of slow-moving stress that often builds quietly, until it doesn't. And here's the twist. The Bank of Japan owns a huge chunk, around 7-8% of the entire Japanese stock market, through its ETF purchases. So when it needs to raise cash because bond values are falling, it starts selling stock. Big stock sales push markets down, confidence weakens, and the Japanese yen starts to strengthen. That might sound good at first, but in reality, a rising yen is like cutting the fuel line of the carry trade. If the yen gets too strong, the whole structure starts to unwind. And that's when the real trouble begins. Before we go deeper into what an unwind could look like, let me throw a quick question your way, because your thoughts really help shape where we take these videos next. With all these global risks building beneath the surface, what do you think is the most overlooked threat to markets today? Let me know down in the comments. I genuinely enjoy reading your insights. Now, here's the Bank of Japan's dilemma. It basically has two choices, and neither one is good. Option 1. Raise interest rates to control inflation and stabilize the currency. But if they do that, the yen surges, the carry trade collapses, global investors dump assets to repay their yen loans, and markets everywhere take a hit. Worse yet, higher rates would make Japan's own debt far more expensive and could cause massive losses on government bonds. Option 2. Stimulate. print more money, weaken the yen, and try to keep the carry trade alive. That buys time. But only for so long. It also raises inflation risks, hurts consumer purchasing power, and could even trigger a crisis of confidence in the yen itself. Right now, Japan seems to be choosing option 2, stimulus, interventions, and trying to delay the reckoning. But markets eventually force the truth into the open. We're in what some analysts call the underwater earthquake phase. Pressure is building, yields are rising, bonds are falling, the yen is shaky, and derivatives tied to yen positions are straining. In August 2024, the world saw a small preview, a sudden spike in volatility that shocked markets for a moment before calming down. That was a tremor, not the main event. If the yen strengthens beyond certain key levels, like 150 to the dollar, the unwind could accelerate quickly. This is the moment financial commentators describe as Godzilla rising, massive, unstoppable, and devastating across multiple markets. Here's how that could play out. US stocks could drop as leveraged positions funded with yen are unwound. Japanese stocks could fall sharply from forced selling by the Bank of Japan and other investors. European markets would feel the pressure as global investors liquidate positions to cover losses. Real estate projects funded with ultra-cheap yen could suddenly become unprofitable, leading to defaults. Private equity deals loaded with cheap leverage could unravel. Crypto and commodities, often heavily leveraged, could see dramatic price swings. Bond and currency markets worldwide could face turbulence. This isn't fear-mongering, it's simple mechanics. When the world's quietest financial engine reverses direction, the effects travel fast. That said, it's not all doom and gloom. The US, for example, has strong long-term tailwinds. The AI revolution, massive infrastructure investments, energy independence, and a wave of reshoring that's bringing manufacturing back home. Innovation is exploding across industries. Long-term, the outlook is bright. But that doesn't mean the road ahead will be smooth. Turbulence is likely, which brings us to what matters most for investors. The old buy and hold, park and pray method sounds comforting, but it's not a strategy. It's a hope. In a world where hidden risks like the carry trade can shake markets suddenly, being prepared is critical. A good approach focuses on capturing most of the upside while avoiding major downside shocks. That means having rules, discipline, and a plan that isn't based on emotion. It means understanding how global forces, from Tokyo's bond market to the value of the yen, can influence your portfolio. Even if you're retired or nearing retirement, these global currents matter. Think of your financial life like a house. You want strong foundations, a structure that can handle storms, and a team that knows how to reinforce it when the winds pick up. That means reviewing your portfolio, understanding your exposure to interest rate risk and leverage, and identifying where hidden weaknesses might be. It means diversifying intelligently, not just spreading money around randomly. And it means staying informed about developments in Japan, because what happens there really can ripple outward. Most importantly, it means focusing on long-term resilience. Markets always recover, but the people who thrive are the ones who prepare before the storm arrives. As we wrap up, here's the big picture. The Japanese carry trade has been a silent giant shaping global finance for decades. But giants don't stay quiet forever. As the environment shifts, we may be entering a period where this hidden engine becomes a source of volatility and shock instead of stability. Understanding it and planning around it can make all the difference for investors looking to protect and grow their wealth. Thanks so much for watching. If you found this valuable, make sure to like the video, subscribe, and ring the notification bell so you don't miss future breakdowns. I appreciate you being here, and I'll see you in the next one.